James Caan from Dragon's Den is an accomplished business buyer, and you know something? He buys businesses without risking a penny of his own money too. Now, on this video, you will see behind the scenes of a huge event that I did during the pandemic. It was a virtual event attended by hundreds and hundreds of people from all around the world, and you will see this amazing interview that I did with James Caan. Like this video, subscribe to the channel, and tap the notifications bell so that YouTube can send you a notification the next time I release a brand new video. If you want to buy a business without risking any of your own cash, then click the information button up here at the top of the video and you can take my free online training course. So click the button, take the course, and let's get started. Let's meet James Caan. Now, James Caan really needs no introduction. If you've ever watched Dragon's Den, without doubt, he was the most popular dragon on Dragon's Den. I believe he made the most investments on Dragon's Den as well. And I believe James is joining us from, is it Monaco, James?
It is. It's not Morocco, it's Monaco.
It is definitely Monaco. Did I say Morocco earlier?
No,
oh,
I'm
right.
just anticipating.
Okay. So, James, good to have you here. Thank you for joining us. Now, there'll always be one or two people who haven't come across you. Maybe there are people joining us from outside of the UK. Would you just give a brief synopsis of your business experience so that we can understand how you can speak with such authority about buying a business?
Yes, thank you, Jonathan. So my background is I started my career in the recruitment business. So like a lot of entrepreneurs, I set up a small recruitment business in a broom cupboard in Pall Mall. There was me, the Yellow Pages, the desk, and the valuable telephone. And I had a vision to build a global human capital business. The business I founded and created was a business called Alexander Mann. And today, Alexander Mann is the world's #1 talent solutions provider, employs 7,500 people in 27 countries with revenues of just over 950 million. So for me, it was an incredible journey that I thoroughly enjoyed, and it created the business that I'm today extremely proud of. I sold that business in 2005 to a private equity firm. And from the capital that I generated, I created my own sort of family office. So effectively taking that capital to acquire and build another business. Because Alexander Mann was my baby, it was a startup, it took 17 years to go from kind of zero to exit. And now that I'm a little bit older, a bit more grey hair, I didn't want to put another 17 years. So the strategy kind of second time round was what we call buy and build. So buy existing businesses to achieve scale. And the two lessons that I learned, Jonathan, was that I found quite unusual and something you wouldn't normally expect. But if you're looking to build a business to exit, what I found is there are more buyers, the bigger the business is, than there are for small businesses. And the reason is because private equity firms spend a huge amount of time and effort in raising capital. And when they've raised money, they generally raise anywhere between 500 to 1 billion. So for them, it takes just as long to do a 20 million deal than it does a 50 million deal. And the amount of time and effort that they take to do that, plus because they have this huge pool of capital, they are charged with deploying it. So doing small deals is quite inefficient for them. So one of the things that I saw was if I was to build scale, I would get a higher premium because it's safety in numbers and people are less nervous when you're buying a boutique business. But also you get a bit more competition for the business and therefore you get a bit of a premium. So the last business I sold, I got 8.6 times earnings, and that was primarily because I had acquired that business on 1.8 million EBIT, which I paid 5.5 times income for, and I exited that on an 11.4 million EBIT at 8.6 times. And what I did, the gap between the 1.8 and the 11.4 was I effectively bought acquisitions where I identified complementary businesses in the market, in the sector, and was able to effectively add to create scale. And then when I had, over £10 million worth of profit, when we eventually did sell, I sold to a UK private equity firm called Graphite Capital. But the good news is I had 3 buyers who were interested in the deal, and the initial offer started at 7.5 times earnings, and we closed at 8.6. So my background effectively is kind of owner, manager, entrepreneur, then effectively became like an investor to buy businesses to scale. So that's a whistle top of my background, Jonathan.
It's a great introduction, and it's very relevant to what people here want to know more about. And I think that sometimes business owners can be stuck in a small business for so long, and it becomes so frustrating. They never get that scale because they are acquiring one customer today, another one tomorrow, and it's very, very frustrating. Where if you can go and buy, like we heard in Chris's example a few moments ago, you can go and buy £800,000 of revenue, another £1 million of revenue. You just speed up the process. And as you said, you didn't want to spend, was it another 17 years?
Indeed,
grinding it out.
Yeah. Absolutely.
So when it comes to funding acquisitions, there is a misconception that you need to put everything on the line to buy a business. In fact, sometimes people almost encourage this belief that you must remortgage your house. You must put your life savings into the deal. Yeah, it's got to be an absolutely, you've got to live your life on a knife edge when you buy that business. But you and I know that that isn't the case. So could you talk for a little bit about financing deals without risking your entire personal financial life at the same time?
Yeah. So I've never, what we call in the trade, bet the farm on an acquisition, meaning I haven't put my entire wealth on the line to acquire a business. So typically what I have found and I think each sector has its own nuances and its own characteristics, but in the sector that I operated in, which was effectively professional services and the recruitment sector, the first thing I learned was, number one, you don't have to buy 100% of the company. So when you're looking at acquisitions, my starting position was never that I need 100%. And actually, as a policy, I never acquired 100% because I want the business to succeed. And when I acquire that business, I want the founders of the acquiring business to be aligned with me. So my model was, I ideally, and every deal is different, but my kind of ideal model was I wanted to buy 2/3 and I wanted the existing owners to retain 1/3. So that, of course, immediately brings your acquisition price down quite considerably. Secondly, if the business that I'm currently running today is profitable and the business that I'm acquiring is profitable, what the banks are always interested in is how do you service a loan? So the combination of the 2 profit streams of your business and the acquiring business gives you an ability to service debt. And typically my model, that what I had agreed with the bank, which was HSBC, was they would lend me typically 2 times the combined EBIT of the business that we were going to create. So if you just make up the numbers for the sake of it, if my business was making £500,000 profit and I was going to acquire a business that was going to make £500,000, the combination of the 2 is £1 million. Therefore, the serviceability of the debt, what I had was £1 million to service the debt. And if the business I was acquiring, for the sake of argument, was making £500,000, that means, and if I was going to typically pay anywhere between 4 to 5.5 times earnings, depending on the size, the scale, the profitability, there's a lot of variables, but just take 4 as a simple number, then effectively 4 times 500 is 2 million. I've already got an agreed facility with HSBC, which is 2 times. So I've got 1 million of debt to do that deal. Bearing in mind, I'm only buying 2/3. Therefore, I don't actually need 2 million. I only need 1.3, of which I've got 1 million of debt anyway. What I then found was when I acquire a business, a lot of businesses in recruitment have outstanding receivables. So outstanding where they are owed money. And one of the things that I learned was not every business that I bought had an invoice discounting facility. And some of the businesses were effectively funding their own receivables. So I could then use the invoice discounting method by taking their receivables to borrow against the receivables as well.
I'm interrupting your video with a very important message. If you are watching a video like this, it's probably because you're serious about buying a business. But watching free videos on YouTube will only take you so far. You need to take the next step. And the next step is a link that's somewhere on the screen up at the top, which takes you through to our free video training. There's no cost whatsoever. You watch the free video training and that will give you some of the essential basics that you need. Now, if you get value from that, then I would invite you to be part of my next Fast Track program. Now, the Fast Track program has been running for a couple of years now. We've had nearly 3,000 people around the world on the Fast Track program, and it's a Zoom program that you can attend from anywhere. It's broadcast from my living room to your living room, where I will teach you what you need to know to go and buy your first business. And there's a Q&A section at the end of each of the training sessions, so you can ask me all of your questions. Now, if you get great value from that and you're really serious about buying a business, then there's my mastermind program, a 12-month program where we hold your hand through the business buying process so that you can buy your first company. And when you have, I'll invite you into our inner circle, which is exclusively for people who've bought their first business. So that's what we've got lined up for you. It's up to you whether you take the next step. Anyway, back to the video.
So if for the sake of argument, my debt was 1 million and, depending on what size of their receivables were, I could generally draw anywhere between 100 to 200 against the receivables, meaning that all I would need effectively is like 100,000 of what you call equity in order to do the deal. So I think the funding was a mixture for A, not buying 100% and therefore limited the amount of money that I needed, B, agree with the bank, the debt facility, and C, use the existing business that I'm acquiring because I own more than 51% and therefore I can consolidate it and leverage the receivables of that business in order to make the acquisition. So as Jonathan rightly said, when making the acquisition, I could effectively acquire a business making 500,000 EBIT, where my outlay, probably from an equity perspective, would be anywhere between 100 and 200,000 pounds, depending on each transaction.
Very interesting, which is contrary to what people believe, which is you have to go and borrow all of the money to pay all of the consideration on day one. The seller walks off into the sunset with all of your money and you're left with all of the business and you've got to sort it out afterwards. So,
which is why, Jonathan, I don't buy 100%.
Yeah.
Because when the owner still owns a third, then there is no sunset for him to walk to because he's still locked into the business.
And this is the classic private equity model, isn't it?
Yeah. And also, I think it's important to realise that banks are rarely ever going to lend you 100% of the acquisition price. A bit like when you buy a property, they never really want to lend you 100%. The typical debt size is between 50 and 60%.
Yeah, absolutely. And of course, the incentive to the owner is to build the business on your behalf with you, because they're going to potentially make more money on the secondary buyout 3 years, 4 years, 5 years into the future.
Correct.
So when we talked before, we chatted about a £12 million acquisition that you did in this fashion. Could you explain a little bit about that one, please?
Yeah. So I had just sold Alexander Mann, And I wanted effectively to do it again, but this time around not organic, but what we call buy and build. And the one Jonathan's referring to was my kind of first foray back into the market. So I identified a business that was making 1.8 million profit. I valued the business at between 5.5 and 6 times earnings, got to an agreed valuation of 12 million. We bought roughly 2/3 of that, which meant we roughly spent 8 million. And the thing that I hadn't quite realized until we did due diligence, this was a business that had been going for nearly 20 years and had always been fairly cash positive, and therefore the owners had never looked to borrow money, and they funded the business through profitability. Because of the nature of the business, it had a very large contract business, which they funded themselves, but it had an outstanding receivable balance when we acquired the business of nearly 10 million. And when we were looking to do the debt financing, the bank had offered us 85% of the invoice discounting. So what I found staggering was I acquired the business, 2/3 of it, and because we were more than 51%, we had control. So we effectively parted with the 8 million. And then within 3 months of acquiring the business, we did a refinancing of the debt book and effectively released the entire 8.5 million. And effectively, when we put the money in, the 8 million, we put it in as a loan into the company, refinanced the debtor book, repaid the loan back to ourselves, and therefore the acquisition effectively cost us zero. We then spent the next 6 years adding to that business, and we made 6 acquisitions and effectively got it to just over 11 million profit. And when we sold that, we sold it for just under 100 million and repaid back the loans that we'd borrowed. But what we had done is a lot of the surplus cash that we were generating, we used that to pay back some of the debt. Because obviously, when you sell a business, the model is it's enterprise value less debt. So whatever debt exists in the business comes off the purchase price. And therefore, I'm always keen to reduce the debt as I go along, because at the end, when I sell, I obviously want to maximize on the return to shareholders.
Very smart indeed. I'm sure there'll be some questions about this in a few moments. But you mentioned due diligence. I know that you have a very different focus on due diligence than what people might typically assume. You obviously look at the commercial aspects, you look at the legal aspects, you look at the financial aspects, but you also look at the people, don't you?
So I think what I do is I've split my function into kind of two. So I'm lucky enough to have an internal team who does the due diligence. So I think currently we've done 53 transactions, and there are effectively 2 lessons we've learned. Is that when they go wrong, there are generally 2 reasons why an acquisition goes wrong. One, the people you are backed or that you've acquired culturally don't fit, and your interests are not aligned. And that creates, tension and friction and can lead to the transaction failing. So I think people, without a question of doubt, is the one single factor that we've experienced. And secondly, due diligence. So when we've acquired a business and it doesn't work out, we always kick ourselves because we find out something after the event that frankly we should have picked up at the beginning that now causes us problems. And I think what happens, just from our own experience, sometimes we fall in love too quickly and we become too emotional because we love it and it's exciting, etc. And we compromise on the due diligence that we do. And regressively, we then end up paying dearly. And so what we do in my own particular situation is I focus on the people. So typically an acquisition for us takes between 3 to 4 months. So I'm effectively courting the management team during that period. And my team is doing both operational, financial, legal due diligence along the way. It's so important from a people perspective that you need to do both business and social. So I have lots of breakfasts, lots of lunches, lots of dinners with management teams because I want to catch them outside of a boardroom and say, are these the people I can work with? Do we culturally fit? Do we see eye to eye? What's it going to be like? Because this is not, one date. This is a long-term relationship. We're going to be together, could be for the next 3 to 5 years, and therefore it's got to be deep and meaningful. And I would say that when we don't do a deal, it is rarely because of due diligence. It's more because we feel uncomfortable that the cultural fit doesn't work.
Which is absolutely intrinsic to the success of your acquisitions, because you are always leaving the owner or the management team in there because you need them to build the business up to the next level.
Indeed, indeed.
So could you give us an example perhaps of where something's gone awry, where a deal has gone off the rails?
Yeah. So when I first set up, my strategy wasn't necessarily to do recruitment. I kind of had an opposite view, and I thought, well, I've been in recruitment all my life. Now that I made some money, I want to do something different. And I went to a lot of the accounting firms, the KPMG, the Grant Thorntons, etc., and said, what have you got that I can buy? And KPMG said, we've got something you might be interested in. It's a sandwich shop called Benji's. It's been around 30 years. It's got 120 stores across the UK. It's got 50 million of revenue, employs 600 people. And it's hit on some rough times at the moment. And I thought, wow, sandwich shops, everybody needs a sandwich, everybody goes to lunch, the market's booming, it's doing really well. And so we looked at it, and at the time when I bought it, the private equity firm that had bought it beforehand bought it making 4.5 million profit, and they were now selling it at break even.
Sorry for interrupting your video, but I wanted to introduce you to a great lawyer in the UK who can get your deals done for you. He's worked for 50 of my mastermind clients in the last few months alone. His name is John Andrews, and I've got his details right here in my little back book of contacts. You can phone him on 0345 241 2494, or you can email him on johnandrews.deallawyer@jmw.co.uk. If you want someone who can get a deal done, he is your guy. So let's get back to the video.
So they'd paid roughly 25 million, and I think I picked it up at the time for about 2. And, it always reminded me what my mother's always said to me: when something's cheap, it's always cheap for a reason. But there's no such thing as cheap. Anyway, so we bought it, it had problems, and I made the classic schoolboy error. Just because I had one business that had succeeded, it doesn't mean that everything you do applies the same way. And we kept the business for 6 months. We couldn't move the dial, we couldn't move the needle, and we lost the 2 million we put in, and we lost another 800,000 of additional working capital we had to put in. So a terrible experience. On reflection, what did I do wrong? What I did wrong was go into a market I knew nothing about. I had no background, no experience, and no knowledge of that sector. We were dealing with perishable foods, which have a short lifespan, and therefore the skill set that I needed to be an owner of that business in understanding the consumer, a high street brand, a product that I'd never been used to. And what I hadn't quite appreciated is consumers are incredibly price sensitive, more than, because if I'm really honest, I wasn't a classic customer of Benji's, and therefore the gap between me understanding the psyche of my customer, I wasn't qualified for. So if the truth be told, everything that could have gone wrong did go wrong, and I probably made all of the mistakes at the same time. The good news is, I knew my own failings, and within a relatively short period of time, i.e. 6 months, I decided to call it a day, because a friend of mine said to me, your first loss is your best loss. If you've got it wrong, don't procrastinate, because every week that decision is taking you was costing us, I think, £85,000 a week. And it kind of focuses the mind of saying, how good do I feel? Because if I'm not confident, I will burn another £1,000,000 very quickly. So at the end of the 6-month period, we said, hands up, got this one wrong, and took the write-off.
Okay, so an observation and a question. So the observation is that this is what I say to people all the time. You buy a business that does something that you understand. Otherwise, you have to learn the business and also learn how to buy the business. So your first acquisition should always be something that you have some knowledge of, maybe even knowledge of as an experienced customer. And again, interesting you should say that you weren't a typical customer of Benji's. So that's, and the question is, how do you protect against personal risk? Because that's many people's big fear. I buy a business, it goes wrong, I lose my house. That's what goes through people's minds. I mean, it's not necessarily very logical, but that's what people do think. So what would you say about minimizing personal risk?
I think it is making sure that you don't give a personal guarantee. So the way that you are exposed personally is generally when you are personally guaranteeing either the loan or the acquisition, at which point failure can be directly on your doorstep. But in the event that you are acquiring the business within a limited company framework, and so, for example, in Benji's case, we put the money into the company failed, therefore we lost our money, but we didn't personally guarantee any of the liabilities, and therefore I didn't risk my house. And having done 53 transactions today, you would think I'm pretty good at what I do, but I still wouldn't give a personal guarantee, because the one lesson that I've learned, if something can go wrong, it generally does. And, I think the current pandemic we are in should be a great reminder to all of us that none of us could ever have predicted this, but it did happen. And in some businesses and some industries, it's been catastrophic. Therefore, when you are giving a personal guarantee, you are taking a massive risk. And the only way to eliminate that risk is just don't do it.
So you've mentioned the pandemic. There's a worldwide recession. It has been a very miserable time for a lot of people. But from the perspective of a business buyer, and I have to say this cautiously because I don't want anyone to misunderstand or misinterpret what I'm saying, but is there opportunity for the astute business buyer over the next few years?
I think there are sectors for sure that have been more affected than others, and that creates a buying opportunity. The thing that I would be very cautious about is where the opportunities lie. They lie for a reason. And it is really important to understand that reason very well, because when something looks too good to be true, it normally is. And just because it's cheap is not a reason to want to buy it. And if the business has fallen on difficult times, you have to investigate that very thoroughly, because you are buying a problem. And unless you understand how to solve the problem, unless you have the answer, then, we must remind ourselves of the definition of insanity, which is to do more of the same but expect a different result. It doesn't happen.
Yeah, I always say never buy a business that's making a loss unless you can answer two questions. Why is it making a loss, and can I fix it? And if you know why it's making a loss and you know how to fix it, then maybe it is a good deal. But if you don't know the answer to those questions, you should be running in the opposite direction. Yeah. So finally, let's talk about the integration of businesses into a group. You mentioned the culture fit earlier. What are the issues surrounding, if you're doing a buy and build, building that group, and what are the things that could go wrong? Let's not just talk about the positive. What could go wrong?
So I'll give you a live example, and I feel pretty bad about this. So we sold a business in February 2020. So we'd been approached by a buyer in 2019 in December. and who approached me and said, look, I really love one of your brands. It's a business I really admire and respect. You're really interested in buying it. Are you interested in selling? We said, always open-minded. Anyway, we got into negotiations. We agreed a deal, and the deal took, again, 10 weeks to complete, and it completed around the end of February. So the deal got done, and what I found staggering was they acquired the business, and in the first week of acquisition, so the business remained in the existing premises, which was an office that we'd had. The buyer sent a manager over in the first week, so nobody massively senior. And then 2 weeks later, one of the kind of directors turned up, and we then hit the pandemic. So the timing for them couldn't have been worse. But the integration was appalling because in that first 90-day period, the business, in my view, is incredibly vulnerable because it's people. So a new owner's taken in, and every employee is sitting there saying, what's the future? What about my job? What about my career? What about my customers? They've got 1,000 things going in their head, and they need the founder. They need to believe in the vision for the company. They need to believe in the vision for the future. And because we'd done the deal, we'd closed the transaction, it was done, we were no longer involved. But I watched from the outside, and I'm sure that the pandemic had a lot to do with it. But within 7 months of the deal closing, virtually everybody in the business had left. And that was literally, in my experience, down to the most appalling integration strategy I've ever experienced, because I just couldn't believe that the founder, and it wasn't a huge business, it wasn't IBM, wasn't in there every day with his arm around the people, communicating future and vision and strategy, and this is the journey, we love you, you're going to be part of the family, etc. None of that. A lot of kind of HR issues and IT issues, and this is our software and this is what we do, and you had 4 weeks holiday, we do it this way, and expense policy. But people were so disengaged. So I think the issue about integration is you need to have a very clear integration plan before you acquire the business, but also you've got to have people that have got to have bandwidth. You can't just allocate somebody who has a day job that's going to spend 20 minutes of his working day. It's too big a risk. You need a dedicated person who's got to own it from beginning to end, that has to be focused around some very clear objectives. So in our case, we have a team of 3, and these are people that are part of the management team who love the concept of acquisitions, etc. And because we have done well in this space, we've spent the money to have them. Now, if you're a smaller business, you use your existing people, but the best advice I can give you is always remember that people you've identified also have day jobs. And therefore, unless they can dedicate enough time, there is a very high risk that that transaction may not integrate well. And if it doesn't, it will cause you problems.
We have some that integrate better than others, so I know exactly what you mean. You've been very generous with your time. Would you take just 3 questions from the audience? Sure. Is that okay? Just 3 questions. We'll limit it to 3 questions. So on your screen, there's that question master participant, and you can send a message to question master, and then it appears on my screen here. And I'm going to select just 3 questions that I think are the most relevant to as many people as possible. So let's have a look. Okay, right. There are so many. This is going to be a tough choice. So Kieran McKay says, "What made you get into acquisitions?" So James, what was it that appealed to you about buying businesses rather than starting from scratch?
It's a great question. I think the answer was that because the first time it took me 17 years. As you can see from the colour of my beard, time wasn't on my side. I didn't want to take another 17 years. And I thought that the concept of buy and build I mean, so to give you an example, the first one took me 17 years, the second one took me 7, and the difference was simply because I'd acquired rather than organically built. So it was time. I wanted to accelerate the process.
Absolutely, and you know, we all look in the mirror every day and realise we're not getting any younger. I know only too well. So if we can just bring those questions up again. Thanks, Kieran, for that question. Okay. We've got a question here. From Ling Lei says, have deals slowed down? And how do we find deals in the UK where at the moment there isn't any, you can't really have physical meetings? Interesting question.
Yeah, very good question. So for us, it hasn't really slowed down because we're still doing exactly the same job as we were doing before. We have our own way of, we don't necessarily rely just on advisors to originate deals. We actively use kind of our networking. So we know the market we're in, we know the sector we're in, and we have recently hired, I think March last year, a kind of a graduate trainee. And, you know, there's a lot of graduates on the market today because they just can't find work. And he's a super smart guy. And we took him on, and his job is he researches the market for us. So we give him direction in terms of the market, the sector, the opportunities. There's lots of different databases and software that's available, including Companies House. He then does effectively a presentation to the team and says, look, you know, I found a company, it's in the same market, the same sector. This is what it does. That's his LinkedIn profile. They're the set of accounts. This is what I've learned online about the company. And so we are targeting businesses directly. We then, if we can find an email address, we contact them directly. If we can't do that, we go via LinkedIn. And if we can't do that, we take their home address from Companies House, and then we write to them directly at home to say that this is a discreet conversation. We'd like to have a conversation about an opportunity we think could be of interest or something like that. And we reach out to the founders of those businesses. So, and we do it currently, it's all on Zoom.
Very, very interesting. I mean, you wouldn't necessarily appreciate this, James, but that's what I always advocate, is that you don't go through intermediaries. You want to have the direct conversation with the owner, because that's where you can get to a deal faster, probably a better deal for all concerned, and certainly faster. And also you can really understand the motivations behind that person wanting to exit or partially exit in your case. And we'll
just on that, when I've dealt with advisors before, one of the things that I find quite frustrating is when I've dealt with an advisor, they want me to make an offer without meeting the management team. And I find that just ridiculous and frustrating, because when I'm buying businesses, I am buying people. And just to make an offer on a kind of cold basis on the back of an information memorandum, I still find it quite difficult. So, you know, it is challenging when you're buying through what they call a process. I think it works for a lot of the big guys, the big private equity firms, but it's been very difficult for me. So I much prefer going direct.
Yeah, absolutely, 100%. Couldn't agree more. So let's go to our final question. So if we can bring the questions up on the screen, and just to let you know, guys, this screen down here on my right isn't working at the moment. Okay, so let's look at something that is relevant to as many people as possible. Okay, this is a good one. Isaac Sturgis. James, what is the most exciting deal you have ever done? What has been the most thrilling, exciting deal that you've ever done?
Great question. In fact, it was done in the middle of the pandemic. It was done last year. I invested in a new platform called Vintro. So Vintro is what I think LinkedIn on steroids. So this is where one of the challenges that we all have is, how do we access key people? So I think one of the biggest challenges that every entrepreneur faces is, how can I access the inaccessible, people who will make a difference to my business? And there's a business in Chicago that was launched called Vintro, and what they have done is they've managed already to sign up some of the most influential entrepreneurs in the world. They're on this platform called Vintro, and you can, and if you're an influencer, so I'm on the platform myself, so I get inundated all the time, people reaching out to me, they want a meeting, they want to sell me something, etc. The problem I get is once you get to a position where you're getting so many people, you just stop reading the emails, you just stop reading the messages because it just takes up too much time. So what Vintro do is if you're on the platform as an influencer, you can set a dial and I can charge £100, £500, £1,000, £5,000. So if I'm looking to attract lots of people, I put the dial down. And if I want to reduce that, I put the price up. So in a way, what that does is that separates the noise from the substance, which I don't have a way of doing at the moment. And I'm currently, I think, charging £500. So somebody sends me a 3-minute video. I get 3 minutes to look at the video and decide. If I accept to engage with that person, they pay the 500. If I don't, they pay nothing. So it's a guaranteed way to reach people. So I'm super excited by that technology because I do think that it's a very clever idea. And I took a stake in that business last year. And I feel this for me could be the one. It could make me a millionaire.
Nice one. And on that note, James Caan, thank you very much for your time. Thank you for being so generous with your knowledge as well. And I don't know whether you can see the screens around me here, but I think everyone's going to give you a virtual round of applause from wherever they are. Thank you very much indeed. We will let
Absolute pleasure, Jonathan.
We will let you get on with your day in Monaco, in the sunshine. Thanks very much.